SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Welcome to this SUERF Baffi Bocconi e-lecture on extending bank stress test results for macroprudential purposes. Stress tests are an important forward-looking tool to support policymakers. By simulating banks' reactions to severe but plausible adverse scenarios, stress tests help uncover hidden vulnerabilities. On 19th November 2025, the ECB published in its Macroprudential Bulletin No. 32, which is also linked on this website, a comprehensive collection of studies on how to extend bank stress tests along various dimensions, notably climate, liquidity, and contagion risks, and feedback loops with the real economy, to bring them closer to possible real-world adverse scenarios. This helps to answer questions such as what additional vulnerabilities emerge once system-wide interactions between banks and non-banks are considered. What's the impact on the system when transition and physical climate risks are incorporated? How do banks' reactions in stress tests amplify or ease downwards? And to what extent does releasing macroprudential buffers during stress sustain lending and support the real economy? In today's e-lecture, key findings of the ECB's macroprudential stress test extension report, in short, MASTER, will be presented and discussed with a focus on risk identification and policy considerations. We are happy and privileged to have with us today a formidable group of top experts from major institutions. In the first half hour, Katrin Assenmacher, head of the ECB's Prudential Policy and Financial Stability Division, Cyril Couaillier, team lead Financial Stability, and Francis Shaw, lead Financial Stability expert, will present key findings from the ECB's new work. Then, three top experts will discuss the ECB's findings and bring in their own results. We're privileged to have with us today Rebecca Mari, Senior Management at the Climate Hub of the Bank of England, Dragan Crnogorac, Team Leader, Risk Analysis and Stress Test at the EBA, and Laura Valderrama, Deputy Division Chief at the Monetary and Capital Markets Department of the IMF. The discussion will be introduced and moderated by Stefan Schmitz, head of the Macroprudential Supervision Unit at the Oesterreichische Nationalbank. Without further ado, over to you, Katrin, Cyril, and Francis.
Yeah, thank you, Ernest. So good afternoon to everybody, and thank you for the kind introduction. We are very happy to be able to present here our macroprudential stress test extension report. And as you will see, it's a joint effort from the whole division. So I'm heading the stress test modeling division, and almost all of the team contributed to the analysis, although it's only three of us who are going to present it today. Yeah, so our analysis builds on the EU-wide stress test that is run by the European Banking Authority together with the ECB. This analysis expands the results to additional risks which the EBA methodology does not cover. And these additional risks are, for example, climate risks, contagion, and also some liquidity risks. We also analyze macroeconomic feedback effects and spillovers from other financial sectors to the banking sectors. Moreover, in this presentation, we present some approaches to measure the severity of the stress test scenario, the adverse stress test scenario, which helps to compare adverse scenarios over different exercises. Our findings indicate that the additional risks lead to a somewhat higher capital depletion, and thus they support a cautious approach to bank capital buffers. And with that, I hand over to Francis for the next part.
Thank you. Good afternoon, and thanks also from my side for the opportunity to discuss this work with all of you. So I will start with the risk identification section, and we'll start by summarizing the first article, which takes a system-wide view and integrates contagion risk across different sectors into the EU-wide stress test. So the article, it expands on the traditional sectoral approach and considers interconnections between banks, investment funds, and insurance corporations. So it uses the ECB ISA model, which enables the identification of amplification channels and second round losses, which can be driven by solvency, liquidity shocks, fire sales, and counterparty interlinkages and exposures. So it builds on the 2025 EBA market risk scenario, which assumes that these shocks occur instantaneously. So looking at the left-hand side chart, this shows the first and second round losses across the sectors as a share of portfolio values. So here we observe that investment funds bear the largest losses, but this is mainly due to their larger market risk exposures, particularly in equities. Banks experience moderate losses initially, given their well-diversified portfolios, but they are still exposed to contagion via holdings of fund shares and bonds, for example. So the middle chart illustrates the propagation of these losses through the financial system. And it highlights how losses can spill over between sectors. So for example, fire sales by funds, they can depress equity prices, and then this can in turn reduce the asset value of, say, for example, banks or investment funds, and this can create feedback loops that amplify initial shocks. So when we focus specifically on the banking sector, we can see in the right-hand side chart, we can see the first and second round effects. So the initial stress leads to an average depletion of about 240 basis points, with globally systemically important banks and investment funds most affected. And this is mainly due to their larger market positions. Second round effects, they add an additional 29 basis points on average. So within this article, there are two boxes, and these two boxes expand the counterparty credit risk framework to include CCP-related losses and to consider correlated default. So box one was actually quite novel in that it links information from ESMA's CCP stress test with the EBA bank stress test to map how losses at CCPs could be passed to clearing member banks. So default fund losses under the EBA scenario when allocated to banks account for an average of about 10 basis points, and they're mainly affecting the types of banks with concentrated clearing activity, which is what we see in the chart on the left. Box two, this explores correlated defaults in counterparty credit risk using Monte Carlo simulations. So when defaults are allowed to be correlated, we see that tail losses for the system rise compared to considering independent defaults. So box two, so we can see in the chart on the right-hand side, this shows the simulated system level losses. It breaks it down into deciles and shows how the different sectors contribute differently as the losses increase with severity. So moving to the next topic, to climate risk. So this second article, the key objective of this article is to enhance the regular banking stress test by incorporating both transition and acute physical climate risks within a short-term top-down framework. So this slide here focuses on the transition risk analysis, and this methodology combines the EBA's adverse macro scenario with the climate pathways set out in the NGFS NDC scenario, which is the nationally determined contribution scenario for 2025 to 2027. So specifically this scenario, under this transition risk scenario, it implies a reduction in emissions, and this leads to a substantial shift in the energy mix at firm level and significant requirements for green investments, particularly for high energy intensive sectors. So you can see on the left-hand side that there's a chart that shows the cumulative green investments for the average firm in the stress test sample. So the impact of this scenario on firms, it results in an increase in leverage as firms borrow to finance this green transition, and a reduction in profitability for some firms, especially those reliant on carbon-intensive energy. So mapping this into credit risk losses results in an increase of CET1 capital at a system level of 74 basis points, which is what you can see in the middle chart, which compares loan losses in the EBA stress test compared to the stress test with the integrated transition risk. And then lastly, what we see in the right-hand side chart is that impacts are not uniform across banks. What we see is that banks, and as expected, banks most exposed to high energy intensive sectors, they sort of bear the largest losses. But what we also see, which is interesting, is that the most affected banks under the climate stress may not actually be the same banks that are most affected under the EBA scenario. So there's banks with maybe different risks. Here we turn to physical risk analysis, and this is presented in the article in a box, and it examines the potential impact of physical climate events, and here it's specifically flood risk on corporate loan quality within the EU-wide stress test framework. So what the analysis does is it sort of overlays the materialization of major flood events onto the combined EBA adverse and the NGFS scenario. And it links like detailed exposure data and NFC portfolios of banks to identify what municipalities and firms which are most exposed to flood risk. And then using this, they estimate the increase in credit risk losses. So what we see is that, and we see this in the left-hand side chart, that most firms have relatively low physical risk, but over 22,000 are in the highest risk category. So this is 5. And in the affected municipalities, about just over 6% of firms with the highest climate risk score are assumed to be impacted, which is what you can see in the middle chart. And then lastly, when we aggregate these credit risk losses at bank portfolio level, we see an additional credit losses stemming from physical risk, flood risk, to an additional 77 basis points in addition to what we see in the EBA adverse scenario. So these losses are generally highly concentrated, both geographically and across banks due to their exposures to flood-prone areas. So I will pass now to Cyril, who will bring you through the policy section.
Thank you, Francis. So indeed, we also have contributions that aim at informing policy. I have 2 of them. And first, we explore the impact of hiring banks to deleverage in the stress test and the impact of then capital buffer release. And we find that deleveraging can slightly increase bank's capital ratio in this scenario, but at a substantial cost for the real economy, which warrants the use of macroprudential buffers. So as you probably know, the EU-wide stress test relies on the so-called constant balance sheet assumption, meaning that banks are not allowed to change the size nor the composition of their balance sheet during stress tests. This is a simplifying assumption that actually could also fit well macroprudential objectives, as the resulting capital depletion is the capital that they would need to absorb the full losses from the stress scenario while maintaining credit supply to the real economy. However, allowing for dynamic balance sheet instead provides more realistic projections and allows for investigating first the impact of bank deleveraging on the real economy, on their capital ratio, and next the impact of, again, capital requirement releases on credit supply on ultimately the real economy. In particular, it is a priori ambiguous whether banks deleveraging has a net positive or negative impact on their CET1 ratio, because individually deleveraging reduces their risk-weighted assets and thus increases their CET1 ratio, which is positive. But a system-wide deleveraging triggers an aggregate negative credit supply shock, which deepens the crisis by preventing firms and households from getting the credit they would need. And in In turn, this increases banks' credit losses and reduces their net interest income, thus weighing on their CET1 ratio. So we have two opposing forces: positive individual deleveraging supporting CET1 ratio and the negative aggregate impact on the economy. So to explore this ambiguity, we use BEAST, which is a top-down macroprudential stress test flagship product of our directorate, to allow capturing first allowing banks to deleverage and second capturing the impact. So we first run it under the constant balance sheet assumption, as you can see on the left-hand side chart, to compare it to the EBA stress test results, and we see that it captures very well the same results. First, as you can see in the total CET1 ratio, two right-hand side bars on the left-hand side chart, and also breaking it down by contributions in terms of profits and loss drivers. And also the correlation is very high at the cross-section across banks, with a correlation above 80%. So BEAST is, in a constant balance sheet setting, is very well able to reflect results of the EBA stress test. From there, we first allow banks to deleverage. It appears that in the adverse scenario of the EBA stress test, this deleveraging has a slight net positive impact on bank capital ratio, as you can see in the chart in the middle. So we move from the blue bar constant balance sheet to the red bar of the dynamic balance sheet, and you see that banks experience a lower depletion of their CET1, which means that the direct positive impact of deleveraging on their CET1 ratio dominates in this scenario the negative impact of the deeper crisis, which further weakens their balance sheet. However, this comes at a cost. As you can see on the right-hand side chart, this deleveraging that supports their capital ratio substantially deepens the crisis, and this warrants a macroprudential action in the form of the release of this countercyclical capital buffer and the systemic risk buffer, which amounted to about 0.8% of banks' risk-weighted assets in 2024 Q4. So by releasing those requirements, as expected, banks absorb more losses through capital because they have more free capital before breaching requirements, and this results in a slightly lower capital ratio, as you can see in the middle chart, moving from the red to the green bar. So you have a slightly increase in depletions, but still preserving bank solvency, as they remain comfortably capitalized and much more capitalized than the constant balance sheet scenario. And because this reduces the deleveraging pressure, this also results in a lower contraction of credit, and ultimately this supports the real economy. As you can see again on the right-hand side chart on GDP, moving again from the red to the green bar, you see that in total this 0.8% release of the capital requirements triggers about a 0.3 percentage point increase in GDP compared to the non-release scenario. So this is in the ballpark of also the literature, and suggests that releasing buffers in such scenarios has a positive and expected impact of supporting banks' credit supply on the real economy without unduly putting their solvency at risk. Moving to the second policy contribution, we use the elasticities of the past EU-wide stress tests between macroeconomic factors and the final capital depletion to inform the calibration of the so-called positive neutral rate of the countercyclical capital buffer. So as you may know, the positive neutral rate is an increasingly popular notion, which calibration is informed via different methods, including stress tests and in several jurisdictions. And the idea is that in the medium phase of financial cycle, the countercyclical capital buffer would be strictly positive. And here we propose a new alternative approach to calibrate this positive neutral rate that relies on the data of the past EU EBA stress test from 2018 to 2025. And using such data comes with two upsides. First, stress test data, because as simulated, are purged from confounding factors that typically affect real data, like countercyclical fiscal monetary measures that are useful, but we want to assess banks' capacity to withstand, to shoulder the shock without those supports. And second, those EU-wide stress test data are widely quality assured and approved by the vast of institutions, which ensure high quality and ownership. So our method consists in computing the elasticity of capital depletion in those EBA stress tests to the macro variables in the past stress tests. And this way, we obtain regularities of expected losses through macroeconomic behavior. Next, we design an adverse scenario that is meant to capture the average crisis when the financial cycle is at the medium phase, so when cyclical systemic risks are neither subdued nor elevated, which is typically the type of risks that the positive neutral rate of the CCYB is meant to cover. And feeding this scenario into the estimated elasticities that we obtained previously, we obtain that the capital depletion of such a crisis that is meant to be the level of the PNR. And as you can see in the chart on the right-hand side, the results of our estimation lie between 1 to 1.5%, which is very much in line with the other calibration methods proposed by the ECB that you can see in light blue and yellow, and also in the ballpark of announced target positive neutral rates of euro area jurisdictions that announced such a target, that you can see in dark blue. So this method provides an alternative view while confirming the calibration levels proposed by the ECB and European jurisdictions. Moving now to the next topic, we also explored how to gauge the severity of the scenarios of the stress tests. And our framework suggests that the severity of the EBS scenario increased over time, with the 20 and 25 scenarios standing out of the most severe. So notably when using nonlinear techniques to account for systemic risks and financial conditions as a starting point of the scenario, the 2025 scenario emerges as the most severe. So digging into the details, we use backward and forward-looking analysis that both point to increasingly severe scenarios between 2014 and 2023, and a slight decline in 2025, or even more stabilization, so to say. So on the left-hand side chart, we build an indicator based on historical data, so the previous stress test, taking the value 0 for the average mild period and 100 for the most severe historical episode that happened with historical data. So by examining the evolution of those key variables, the average mild episode is would be associated with a very low value, and as we increase and match more extreme historical values, the adverse scenario will have a higher score. And we see very clearly that we had an upward trend between 14 and 23, mostly driven by the increase of unemployment and also ITRACs. So again, it means that the scenarios were more extreme when expressed in terms of historical events. Then we also use in the middle chart some forward-looking scenario. That means that we capture the plausibility of the scenarios compared to forecasts. So at each period of time, we compare what was the adverse scenario of the stress test with the range of projections at that point in time as computed by the ECB. And we see the same, that between 2020 and 2023, we moved toward higher value of the tail risk, so meaning that we are capturing more extreme events before a slight decline in 2025. However, this is without accounting for systemic risk. We just compare all the scenarios of all periods without accounting for maybe structural changes or cyclical changes that might have affected the probability of the scenarios. And this is what we do in the right-hand side chart. Here, we correct for this by computing first a financial stress index. Then we build a growth at risk method in which the severity of the crisis for a given shock increases with this level of financial stress index, so that the same shock will have a stronger impact. And finally, we compare the scenario severity of the past stress test while controlling for this level of systemic stress. And what we see is that the cumulated growth of GDP in the last 3 exercises declined between 21 and 23, and then even more, a bit more in 25, which suggests that, sorry, the blue one, sorry, decline, But actually, when controlling for the impact of this systemic stress, it increased, meaning that we are now controlling for the level of financial environment. We are now having more adverse shocks because we are actually in a relatively safer environment. So we need stronger shocks to reach our scenario. So those methodologies provide a multidimensional way to assess the severity of the scenarios, backward-looking, forward-looking, and also with the possibility of taking a view compared to the macro-financial environment that is currently ours. And with this, I will give the floor back to Katrin for the conclusion.
Yeah. So as I see all the questions coming in, let me say that these are all our own views and not the views of the ECB. So what we say and present and answer here is our own view. But now let me wrap up. So what did we learn? On the left-hand chart compares capital depletion across the different exercises. And the EU-wide 2025 stress test result is the red bar, which is around 100 basis points lower than in the previous stress test 2023. Climate risks, so physical and transitional, each add around 80 basis points to the depletion. Our top-down BEAST model under the constant balance sheet assumption is slightly less conservative than the EBA methodology, but it yields fairly similar results. So in the next block, when banks can deleverage, they can reduce their balance sheet and bolster their capital ratio. So depletion is lower. Spillovers from investment funds and insurances, so these other financial sectors, increase bank capital losses by around 30 basis points. This is the light yellow part. The system-wide losses overall are not comparable to the losses from the stress test because the system-wide model focuses on liquidity stress, and we look only at the losses that occur in the first quarter of the stress test. The waterfall chart on the right shows that the different effects accumulate to a net impact of around 40 basis points. So we would be 40 basis points higher with some additional depletion for additional risks, but also some gains, so to speak, from relaxing the methodology. Next slide, please. So beyond assessing these additional risks, our analysis can be used to investigate how individual banks are affected. The left chart shows bank-level correlations between our results and the EU-wide exercise. Bank losses from exercises that expand risks that are already to some extent reflected in the EBA methodology, such as the exercises relying on a dynamic balance sheet, counterparty credit risk, or spillovers, they are positively correlated with the results from the EU-wide exercise. Interestingly, the banks that face the largest losses in the EU-wide stress test are not those most vulnerable to climate risks. So Francis already said that we have a negative correlation here. The middle chart shows the risk exposure amount of banks in the bottom 20 percentiles of each exercise. In the EU-wide stress test, we can see that these risk exposure amounts are relatively small. So these are mostly smaller banks that are in the tail of the distribution. Whereas on the opposite end, the system-wide analysis mostly brings large banks to the tail of the distribution. So system-wide spillovers affect large banks more. Finally, the right chart shows that the number of banks breaching the maximum distributional amount threshold varies across simulations. Here, the number is largest for the climate exercises. And our analysis also shows that in the dynamic balance sheet setting, the ability to release capital buffers cuts the number of banks that are at the MDA threshold by half. So that's the yellow bar in the block. So concluding here is we do get additional evidence beyond what is just the assessment of the quantification of additional risk. Overall, our analysis confirms that euro area banks are resilient to a variety of risks, but that pockets of vulnerabilities exist. We also hope to have convinced you that the EU-wide stress test provides valuable input for broader macroprudential analyses that can be used to assess additional financial stability risks and as well inform macroprudential policy measures. And with that, I would like to conclude and hand back to Stefan for the discussion. Thank you very much for your attention.
Thank you, Katrin, Cyril, and Francis.
Thank you. Rebecca, the floor is yours. Thank you very much, Stefan, and also to the ECB colleagues for the presentation. First of all, in a similar fashion as Katrin disclosure, I would like to say that these are my own personal views and do not represent the view of the Bank of England. In my remarks, I will focus on two of the chapters of the extension report that we have seen presented today. One is the one on the framework to assess the severity of the adverse scenarios in the EU-wide stress test, and the other one is the one on integrating climate risk and stress testing frameworks. In the chapter on the severity assessment framework, the ECB colleagues present a novel forward-looking methodology for assessing the severity of adverse scenarios published, and of course also the calibration of future scenarios. I deem this work incredibly valuable for stress testing scenario design, particularly in a world with increasing complexity and variability of what a shock looks like, and also an increasing richness of stress test scenarios. As we experience more recessions with variable nature, the backward-looking approach that was traditionally used to assess both the severity and the plausibility likelihood of a scenario becomes an increasingly poor plausibility assessment tool. So the forward-looking approach that our colleagues presented using joint probability models of relevant scenario variables constitute a clear advancement in the ability to calibrate plausibility and internal consistency of scenarios for stress testing. And particularly this internal consistency as well is a very important element and are to achieve exclusively from backward-looking methods. The ECB paper referred also to our own, the Bank of England 2025 BCST scenario publication. Although we publish only reference historical figures for the GFC along with the scenario severity, over the last few years, we have also moved towards the adoption of joint probability distribution models for key variables to support our scenario calibration and indeed also the consistency of the scenario calibration there. The forward-looking approach presented in the publication becomes, I think, even more valuable in a world in which novel risks are emerging. And of course, as you might have guessed by my job title, I think I would like to focus particularly on climate risk. I think climate risks nowadays are no more within the realm of exploration. Both of our institutions have conducted exploratory stress tests, but climate risk, there is a growing awareness that they constitute today some elements of those severe but plausible short-term risks, and therefore fall within the generally accepted boundaries of the standard bank capital stress testing risk targets. Now, the climate scenario exercise that is presented in the ECB bulletin is the necessary step of exploration to go towards that direction. And I think brings out also a few key considerations that I would like to share with you today. So some elements of climate transition risk are still missing from the standard stress testing frameworks have already crystallized. Emission trading schemes, for instance, already represent the current reality, and yet 2025 bank capital stress test scenarios, the core, of course, not these extensions, didn't really capture those elements yet. In our Bank of England 2025 BCST narrative, we mentioned the link between gas and carbon prices, but we ask banks not to process the information in this 2025 exercise. The ECB integrates in its extension chapter the NGFS nationally determined contribution scenario into the EBA 2025 adverse scenario. The NDC scenario, in principle, represents the current expected path of energy transition. And in the ECB analysis, it is presented as an overlay on top of the standard 2025 adverse scenario. But one wonders if, from a pure risk perspective, that shouldn't be considered simply an overlay to the baseline, rather than the stress test scenario, being that the central expectation, potentially. So path for transition, more severe than the NDC one in a stress test scenario, would mean a testing for climate as a source of the shock in a stress testing scenario. A path consistent with NDC in the stress scenario instead would simply ensure that the stress test scenario is conditioned on the expected transition. And when that same path is also included in the baseline, it would allow to capture the amplification effect of transition on the stress scenario. As we reflect over the best practice for climate risk integration in standard bank capital stress test, I think it is important to really reflect on the meaning of each of these choices in a scenario design from a risk management perspective. And I think this is very much the time to do this, as we have learned through a lot of exercises a lot more on climate, and we have deepened also our expertise in general stress test scenario design through novel methodologies and experience simply in the field. So the question, maybe a bit of a challenging question that I would like to leave my intervention with is, should expected transition be still treated as a forward-looking shock, or should it simply be an expectation against which a stress test scenario should be conditioned upon? I think this is something that would be good to think about. Thank you.
Well, thank you, Rebecca. Dragan?
Good afternoon, everyone. So first of all, I'll add as well the caveat that most of the views here are mine and not necessarily from the EBA. And I would also like to thank you for inviting me to the event. And I would like to thank the ECB colleagues and all the people involved for this very solid and comprehensive forward-looking piece of work. It's a valuable contribution to the macroprudential debate. And clearly shows progress made also at the ECB side. I must say that we cooperate very well with the ECB, and you all know that, and I think it was mentioned also by Katrin. So I hope my comments won't be biased. I'll have an overall kind of a comment or assessment, and then I'll go to a couple of pieces in the bulletin. So overall, what I see as particularly positive in this work is that it clearly goes beyond narrow solvency focus. So it looks at liquidity risk, climate-related risk, contagion, and systemic interactions. And this broadening of scope is essential. It's essential, especially since financial stability risks do not materialize through only one single channel. And the paper rightly highlights the importance of analyzing multiple dimensions altogether. So the second point, which is kind of an overall assessment, is that, or important takeaway, is that this work illustrates very well why top-down models are essential in complementing the work of supervisors, macroprudential authorities, and regulators. They allow for greater flexibility, what I said in the interaction of risks. They also allow testing alternative assumptions. They allow extensions, which we saw in this work. And doing so, they don't place additional operational burden or resources on market participants. This is all particularly relevant when we're looking at emerging risks or risks like climate, which was mentioned and which was presented also in the bulletin. But obviously, at the same time, as the also ECB colleagues and probably all of you would certainly confirm, is that good analysis and good models require proper focused and high quality data. And I would emphasize focus rather than systematic data collections. The objective is not to collect everything, but to collect what is truly needed for sound analysis. And this is very much what our goal is going forward. So we just to do a bit of advertising. So we started with the discussion on the 227 EU-wide stress test as the EBA. We had talks with the industry and especially banks participating the previous stress test. And where we're going forward is that we will focus on simplifying the exercise, both in terms of methodological assumptions, templates, especially reducing burden for banks in terms of reporting connected to stress testing. But what we also focus on is to connect perhaps part of this reporting and starting points with supervisory reporting, which is regular, and it's perhaps easier to do for banks, especially when it's connected to accounting standards. We will also work more on developing our own top-down capacities and work on the collaboration platforms, which we saw as very valuable in the 225 exercises. And it was also confirmed by banks that it was very simple to use and positive in terms of reducing resources. So let me focus now on a couple of points in the bulletin. Let me try briefly to comment on the work on dynamic balance sheet and reactions and macroprudential policy. So basically, these points that I'll comment are also in a way connected to the EU-wide stress test, the macroprudential one, and therefore I'm focusing on this. So I find it particularly encouraging that the analysis on this dynamic balance sheet reactions and buffers shows that release of macroprudential buffers helps reduce the impact on the real economy, because this is a message, this is an important message because it really gives a meaning and credibility to the buffers. Buffers are not just there to accumulate in good times, but obviously to be used when risk materializes, and support lending capacity and help smooth the cycles. Demonstrating this mechanism analytically is very valuable for both policymakers and communication with the public. But at the same time, for not being biased, so I looked at the chart one, and perhaps some of the readers did as well, and it is a bit thought-provoking. At first hand, it feels somewhat counterintuitive to see that under certain assumptions, banks appear to be worse when buffers are released. So the economy does better, but the buffers, but the banks have a higher impact than when the buffers are not released. So one might expect that there would be at least some offsetting benefits for banks, for example, through higher net interest income, perhaps lower credit tightening, or fewer impairments as the economy performs better. But this raises, in a way, interesting question, whether what kind of assumptions were used for the model and perhaps some behavioral responses. It may be, but our colleagues can confirm that the results reflect conservative assumptions on banks' reactions, or on how quickly macroeconomic improvements feed back into the bank's balance sheets. From a macroprudential perspective, this kind of results is actually very useful, as it helps us better understand under which conditions buffer release is most effective, and where modeling refinements could be further strengthen the policy narratives, especially when connected to the impacts to the banks. I'm turning now to the climate risk extension. I would like to say that I generally think that this is a very strong and welcome extension of the stress test framework. It is methodologically ambitious and clearly goes beyond what has been done in many previous exercises. But I have obviously some comments as well. So one assumption that is worth reflecting in the transitional part when we look at transitional risk is that, and this is in a way a constructive observation, I mean, there are explanations for that, is that the implicit assumption that all green investments are equally efficient in reducing emissions, that's something which personally I wouldn't believe. But because in reality, we know that technological progress often follows the S-curve. Some sectors or technologies have very high potential for emission reduction, while others may already be close to technological limits, with marginal gains close to zero. So differentiating more strongly across sectors in this respect could further refine the results over time. Another is on a physical risk, and in particular flood risk. So I find the analysis very insightful. I think the results show how many actual companies are exposed to such risk. But at the same time, I do hope that this is in a way an example, so it can be further made more comprehensive in terms of physical risk. And this is more as a policy reflection than a modeling critique. That such results do not, so I hope that such results do not inadvertently drive banks away from certain regions or types of exposures that may be more exposed to this so specific physical risk. From a macroprudential and in a way social perspective, the challenge will be to ensure that risk is properly priced and managed without leading to abrupt withdrawal or financing from regions that may need investment the most including for adapting to such risks and to be more resilient. And finally, one last point, which is connected to measuring scenario severity in a forward-looking view. Again, this is a very important topic because discussion on stress test design almost always come back to the question of plausibility versus severity. In practice, we often face the reality that some of the most disruptive scenarios are impossible to predict or even to hypothesize ex ante. So this makes the effort to develop more systemic and transparent severity metrics particularly valuable. I was curious although I was really curious when reading the paper whether, I think it's called the divergent metrics. I would call it in a way distance from median measure is applied consistently across all variables, or whether it is mainly focused on a subset of key macro financial indicators. So perhaps a clarification here would help me understand. Related to this, there is also a question on how the framework behaves when the baseline itself is already weak. So when just before the crisis, the baseline might be very weak, and how would this framework behave on putting an adverse scenario in that case? Or also, we tend to see a lot of optimistic baseline scenarios, which then also pose a question how this would work in an optimistic. So from bottom-up stress testing perspective, we all know that there's one practical challenge, and once an exercise is underway, there's often a temptation to update or adjust scenarios if conditions change materially. However, doing so would significantly increase costs and operational complexity for both us, the authorities who do it, and the banks who are involved. In that sense, the approach helps ensure robustness and design of the scenario ex ante, and it helps us also find the arguments why we chose such a scenario. And I'll stop here and apologize for taking a bit more time.
Thank you very much, Dragan. Laura, your turn.
So good morning. So thank you so much for the opportunity to participate as a discussant. So just the usual disclaimer applies. So that is my personal views, not the IMF. The extension that was just discussed presents key innovations with respect to the 2025 EU-wide stress test in terms of the scope, as it includes banks and non-banks. Also, it integrates microdata from different sources and assesses the impact of policy interventions. Some innovations are also related to the of risk transmission, including climate risk, viruses, and intersectoral exposures, as well as a targeted analysis of losses from CCP member default. And in terms of methodology, it allows for relaxing some of the constraints in the EBA methodology, considers also dynamic balance sheets and deleveraging, and evaluates also a targeted assessment of correlated defaults. So in terms of the magnitude of the results, on average, it seems that the impact of the macroprudential extensions are relatively small at about 40 basis points. And also they are mainly driven by climate risk, which is the first red column in the chart. Also another challenge in aggregating these results across different risk factors is that they do materialize in different simulation horizons. So for example, climate risk tends to materialize over 3 years, whereas the contagion from non-banks tends to be more short-lived. So my main comments will focus on the extension of contagion risk from non-banks. Suggestion would be that the model could incorporate additional solvency channels, particularly stressed counterparty credit is material. So I'll try to share with you the exploratory exercise that we conducted for the euro area FSAP. So this, I don't know if you, okay, so this, I just wanted to mention that So this tries to quantify the channels that we suggested in the previous slides, but also it's exploratory exercise, and the reason is that it relies on behavioral assumptions. At the same time, it has some results that can inform policy decisions. So in terms of the high-level setup, so we'll consider 2 different scenarios. And the reason is that the size of shocks, as well as the behavioral assumptions, will depend on the time horizon of the simulation. So we consider 2 days and 2 weeks. In terms of the transmission of shocks, we consider asset revaluation, and that will include the value of funds assets, but also the value of securities, as well as derivative positions. What is the liquidity demand that we can expect in these scenarios? They will come from 2 sources. So one is redemptions from investors. The other one is collateral calls on repos, rollover risk also on overnight repos, but also variation margin in derivatives. So in terms of liquidity supply, certainly participants that may have liquidity shortfalls, they can take a range of actions to raise liquidity. And here we show the pecking order, which is based on cost considerations. So stress, let's say, funds, or they can withdraw bank deposits, roll off maturing reverse repos. This is a critical aspect, which is borrowing via the repo markets, or selling off liquid holdings like shares in MMFs or ETFs. And only as a last recourse, they will sell portfolio assets because they recognize there will be fire sales. So in terms of the results, so what we find is that they do depend on the horizon. So here we present the 2-day scenario, that's the left chart. So the size of the liquidity shortfall for all the funds that's domiciled in the euro area, so it would be around like 20 billion. But the important thing is that most of the source of the liquidity will come from variation margin. And the reason is the T+2 cycle of selling securities in Europe. So whereas margin calls, however, they have to be delivered the day after the shock. However, if we move to the right bar under the 2-week scenario, so there, because of this T+2 cycle, so that we will observe redemptions of investors that will be the main driver of liquidity stress, and that's the orange area. In terms of the size of the liquidity demand by investment funds in the euro area will be about 700 billion. So now, so we have now 2 slides. So on the, what does it mean? Yeah, what is this liquidity shortfall? What does it mean for the financial stability in the euro area? So it depends on the scenario. So for the 2-day scenario, the main spillover channel is counterparty credit risk, particularly in derivative transactions. But these, the size of this counterparty credit risk will depend crucially on the ability of stressed funds to access repo markets. So that's why we do have a chart that shows different results across different assumptions on repo markets. The left-hand side is when there is no additional access to repo markets by stressed investors. Middle chart is when they could access new repo facilities, but this is only to historical maximum. And the third chart is when they could actually encumber all the available security in the collateral pool. But what we observe is the most realistic assumption is the left-hand side, which shows that around 50% of the variation margin, which is due from funds to banks, may not be fulfilled. Banks typically, they are neutral in their market position, so they may be forced to liquidate these derivative positions, and that would create big losses, as we saw in the case of Archegos. That was around 10 billion for exposed banks. But then if we move to that's the last slide, if we move to the 2-week scenario, so the spillovers are actually going to be in terms of impact to on prices in core markets, but also financial institutions, including the fund sector and the banking sector. But what I want to highlight here in this slide is that the magnitude, but also the channels of spillovers depend crucially on behavioral assumptions. So one is the liquidation strategy of stressed funds. whether, for example, pro rata waterfall, but more crucially, as I mentioned earlier, on the access of the repo market and the stress. So what we find is that, for example, if we are concerned about resilience of the sovereign markets, so I'm thinking about for example, the UK crisis in 2022. What we find is that facilitating repo borrowing from funds can actually significantly mitigate spillovers. So for instance, if we look at this column in yellow, core markets, if stressed funds, they have no access to new repo, the price impact on the euro area sovereign bonds could reach up to 350 basis points, depending, of course, on the rating and maturity of the security. However, if these stressed funds are able to access repo facilities, this impact would be reduced to no more than 85 basis points. So this is one key aspect. The other aspect is that we are interested in intersectoral contagion. So what we find is that money market funds can actually transmit stress. And the reason is that they are used, of course, as a liquid instrument, and they do hold big amounts of commercial paper, which typically is issued by banks. We find, for example, that overall, under some.
Sorry, Laura, we have to close in 2 minutes.
Yeah, we have to close. Okay, yeah. So the final, So the final key takeaways is that, the system-wide analysis can help calibrate CCR losses under consistent scenarios, which is also in terms of is consistent with the guidelines of ECB, but also importantly, we need to pay attention to the behavior functioning of the repo market for financial stability. Thank you so much.
Thank you, Laura. We have 2 more minutes, but I think when we allow funds and other NBFIs access to the public safety net, for example, in the form of emergency liquidity assistance, I assume that would go hand in hand with stricter supervision, or do you think we subsidize their risk taking for free?
Yeah, so certainly, so that's So I want to say first, answer the question. We do have the IMF published some reports, exactly addressing this question. Certainly has to be accompanied with greater, of course, supervision and regulation. But also, as you said, one of the policy recommendations could be, like considering this greater access to facilities by the central bank. But also it could be another policy action actually is to facilitate, the provision of repo by banks themselves. Because many times, they are, they do not provide liquidity to stressed counterparties because of their internal limits, and also because of the encumbrance of their own balance sheet. So this is something we also explore.
Thank you very much. I think Laura's presentation was also a very good answer to one of the questions in the chat on how NBFIs and banks interact and how that's modeled, and that's a great example.
I would like to react to the Rebecca's remark and also Dragan's remark on climate risk stress testing. Climate risk stress testing is a very much evolving area, and I think there is not yet any agreed methodology or any agreement on channels and how to model that. So we focus on very limited risks. So you may say, okay, the aggregate impact is not that big, but you also need to consider that we only look at impact of green investments and emission, on carbon emissions on firms, and in the other exercise on flooding risk. So it's very, very limited, but I think the discussions that we are having here already gives ideas and gives angles to broaden this analysis and to get to a better understanding. So I very much like your remarks on should it be on the baseline or on the adverse. We thought we add to the adverse to capture nonlinearities, but indeed we can think about adding to the baseline and see if we capture nonlinearities in a different way. The other remark that I wanted to make is on the scenario severity by Dragan. We have scenarios for the EBA which focus on a limited number of variables, but I think the macro part is limited and the market risk part is already vast, so we cannot look at all variables. if we do scenarios for the ESMA and the counterparty credit stress test, the central counterparties stress test, we have hundreds of variables, even thousands of variables. So I think we need to focus on something that is characterizing the scenario. And what we expect is also that this will ease our communication efforts in talking about the scenario, because nowadays, at the moment, we focus mostly on GDP decline, but that's not everything that matters. So I think the real estate prices, stock markets, so matter also interest rates are core variables that have a big impact and that should be considered in such a measure. So we are much more modest than trying to reflect everything. And what you mentioned on the baseline, weak baseline, is more, in my view, a question: how cyclical should a scenario be? That's a different question. And it's very important, I fully agree, but I think it's not something that we address with these severity measures that we are proposing. With that, I would hand over to Cyril or Francis, whoever would like to respond to other points.
I can reply to Dragan on a point on the dynamic balance sheet. So you mentioned that you were surprised by the fact that when we allow, or when we release the buffers, actually capital ratios further decline, and suggesting that you would have expected that the positive impact on the economy should have actually increased the capital ratio. So actually, exactly this channel exists and is captured by the model. There are two channels, I think. First, because you release requirements, you allow banks to absorb more losses via reducing their capital before they have to deleverage. And this mechanically increase their losses, the decline in their CET1 ratio. They accept this rather than deleveraging. And then, because they do that, the economy contracts less, and this indeed supports their NII and reduce also their credit risk losses. And in chart 1 of the article, this is exactly that we see that the decline due to lower NII and higher credit risk losses or market losses are reduced. But this is dominated by the impact on the CET1 ratio that banks deleverage less, basically. So the impact on the numerator, the RWA, dominates the positive impact on their production of capital. But this is exactly captured. So thanks for clarifying this point.
Okay, thank you. So I suggest that we look at the questions in the chat, and I would kick off with a few questions myself. The first one is that it seems that the feedback effect you've just mentioned, Cyril, is implausibly high, and it's all driven by one equation in the model, table 33 in Budnik 2022, which I think refers only to 110 large banks and ignores the endogeneity of capital also in the short term. And in terms of policy making, it's really focused on large banks. And I don't think it would apply to Austria, where we have 380 banks with an average excess capital of 10 percentage points. So they wouldn't even notice whether or not the PNR is 0.5 or 1.5%. And the second comment is that I think we have too much focus on bank credit. In the past, bank credit used to be the single most important source of debt financing for NFCs, but that's no longer the case in Europe. And so I think we should take into account credit substitution more directly and focus more on these issues rather than the obsession with bank credit. Now, the questions from the chat, I will present a selection. The first one is, Wanda asks how you take into account the overlap between different requirements, the leverage ratio, the CET1 ratio, and MREL, which turned out to limit the usability of buffers even when they are released. Is that something you can model in your equations?
So I think I will take this one. So on the last one, we have the leverage requirement on the MREL requirement in BIST. So banks have to comply with those requirements. That means say that the bonds are well capitalized, and they have also, and basically the fact that those requirements that are released also sit on top of the combined buffer, the conservative capital buffer, means that this usability problem would not be major for the set of requirements release that we have explored. But this is captured, yes.
Okay.
Then second,
Thank you.
Stefan, you mentioned the impact of the feedback loop. So let me clarify something that probably we did not mention for the sake of time during this presentation, but is in the paper. In the constant balance sheet, we force banks to maintain their capital, and sorry, their balance sheet. So we do not allow them to deleverage at all. So implicitly, we force them to continue supporting and financing the economy. So what we did is that we took it seriously, this assumption that banks maintain their credit to the economy. So that's when you allow for dynamic balance sheet, this entire reduction in credit is not yet accounted for in the scenario, and you must account for it as an additional shock on the scenario. So basically, what you have as an impact of the balance sheet is about, I think, the credit falls by like 10 percentage points in our simulation, as in impact in this big contraction, 10 percentage points on GDP. This is what you have. So it doesn't seem so implausible for me. And you also mentioned the coverage of
Cyril, I think
banks.
the US Fed would respond to that well when we base our scenarios on a consistent scenario selection and composition process, then that feedback effect is already captured in the minus, say, 5 percentage points of GDP that we start with.
Okay, but then if you do that, it's just a matter of point of reference, no? Because it means that once you allow for dynamic, you should, or if you want to be suitable, if you want basically to capture the difference between constant and dynamic, you should have a starting point that is purely constant. So it means that you should have started from a weaker, less adverse scenario, but the gap should still capture the entire difference.
Okay, good. Thank you. Marcel has an interesting question, and he wonders whether dividend restrictions wouldn't do the same job, albeit by increasing resilience at the beginning of the crisis, so the banks have probably higher capital ratios starting into the crisis, which they can then make use of, as we did in 2020. Would you model that? Can you integrate that in your model as well?
This could be tested into BEAST. Hasn't been the case because we focused in the standard toolbox of policymakers, and this was a very ad hoc tool that is not typically part of the CRD.
Okay, thank you. Ernest argues that if the reduction of macroprudential capital buffers is so growth positive in your model, why not reduce these macroprudential buffers as a standard in growth policy?
So here, there are two reasons. One, I think, relates to also another question that was raised in the chat, is that we want also to ensure solvency. So we must ensure that when we release capital requirements to allow banks to use this extra capital during crisis, they are still capitalized enough. So we cannot afford to have rock bottom capital requirements when we release. That's the first point. And the second point is that there are non-linearity in the impact of requirements. And typically, releasing requirements in a crisis time works well because it's a moment that capital is a constraint for banks. Capital is costly and capital is under pressure. While in quiet times, capital is easier to get from banks because they can generate it internally from profitability, and it's rarer, but they can also raise it, you know. And there are tons of papers that show this non-linearity and the fact that basically requirement release during crisis time has a bigger impact.
Okay, thank you. We have a question from David, who asked, is there an interlinkage between the transition and physical risks in the model in terms of, for example, feedback loops?
So no, at the moment there is no interlinkage between transition and physical risk. The way we model the physical risk in this analysis is very distinct from the transition risk. So what we are doing here is really looking at areas that are affected by doing a granular analysis with looking which firms are subject to flooding, which firms are subject to disruptions resulting from flooding or flooding of their environment. So at the moment, we don't see a way to have both in the same scenario and also have both in the same analysis and have these feedback effects. Going back to your question on why we are so focused on banks. That's just because ECB is involved in banking supervision. So we are not the supervisors for funds or insurances. We have problems in accessing supervisory data for these areas. So for our system-wide analysis, we are using market provider data for the fund, and we are using country-level data for the insurances. And this, of course, hinders the analysis. So a closer collaboration between supervisors of these entities and the ECB would, of course, help us a lot in refining the system-wide analysis.
Do you mind, Stefan, if I come in quickly
yes.
on the point between a transition and physical risk? Just to point to the person who asked the question, that as at the Bank of England, we published in the financial stability report that was published in December, we have a section where we don't do exactly a scenario exercise like our ECB colleagues have done, but we look at the current exposures of our banks that took part in the 2025 stress test. And we deep dive into mortgages, and we look within the mortgage portfolio both at physical and transition risks and the way those two interact within the same portfolios. So that is possibly something that could be of interest, as it shows the overlap between the two.
Super. Thank you, Rebecca. Laura, you are back. We are at the end of this event, and having followed stress testing over the last 20 years almost, the master program and Laura's stress tests are a great example of how much progress has been made over these 20 years in terms of complexity and depth of analysis. And that's a very good result of this event. Thank you very much. Ernest, would you like to say a few words at the end?
Thank you very much. This concludes our SUERF Baffi Bocconi e-lecture on extending bank stress tests result for macroprudential purposes. Thanks to Katrin, Cyril, and Francis, Rebecca, Dragan, and Laura for the excellent presentations and the open discussion. And thank you, Stefan, for the moderation. Thanks to all of you for your interest and for your participation and for the many questions in the chat. Thank you. Bye-bye and take care.
Bye.
Bye.
Take care.